Hey everyone, welcome back to Legacy Analysis, your go-to source for deep dives into the stock market. Today, we're zeroing in on some of the most talked about high-paying dividend companies in Canada and the US. These aren't just about great dividends. We're going to analyze their future growth, challenges, opportunities, and the market trends shaping their trajectories. Grab your coffee and your notepad. This one's going to be packed with value. Let's jump in. Kinder Morgan, one of North America's largest energy infrastructure companies, had an incredible run in 2024. With a 4.2% dividend yield and strong earnings growth forecasted for 2025, this stock is a staple for dividend-focused portfolios. What drove its 2024 success? Rising demand for natural gas, particularly for liquefied natural gas, LNG, exports to Europe and Asia, bolstered Kinder Morgan's revenues. Additionally, its disciplined capital allocation strategy helped reduce debt while maintaining consistent dividend payouts. What's ahead? The global push for energy security means Kinder Morgan is well positioned to capitalize on LNG demand, which is expected to grow at a compound annual growth rate (CAGR) of 7% until 2030. However, risks include fluctuating energy prices and regulatory hurdles, particularly as governments push for cleaner energy. Key takeaway: Kinder Morgan is leaning into renewables with investments in carbon capture and storage (CCS). This diversification could be critical as the energy transition accelerates. Dow Inc. might not be as flashy as tech stocks, but its 7% dividend yield makes it a reliable choice for income investors. While the materials sector underperformed in 2024, Dow remained resilient thanks to its diversified product portfolio in plastics, chemicals, and packaging. What's driving future growth? Dow is focused on increasing operational efficiency and reducing costs, aiming to save over $1 billion annually. On the sustainability front, the company plans to invest heavily in recycling technologies and carbon reduction initiatives, aligning with global ESG trends. Challenges: slower global economic growth could dampen demand for industrial materials. Plus, rising interest rates make debt more expensive, which is something to watch given the capital-intensive nature of Dow's operations. Verdict: Dow's proactive cost management and commitment to sustainability position it well for long-term stability, even in a volatile macroeconomic environment. Shifting gears to Canada, let's talk about C Financial. With a forward dividend yield of 2.59% and a stock price that soared 117.3% in 2024, C Financial has been a breakout star. Why the surge? The firm aggressively expanded its wealth management division, acquiring several US-based advisory firms. This strategy diversified its revenue streams and increased assets under management, AUM, to over $150 billion. Future outlook: C Financial plans to double down on its US expansion, where margins are higher. However, challenges loom in the form of rising competition from fintech disruptors and potential margin compression due to higher operating costs. What to watch? The company's digital transformation initiatives. If executed well, these could significantly enhance client retention and profitability. Canadian Western Bank, with a forward dividend yield of 2.45%, has been riding high on the back of Canada's economic recovery. Its 97.8% stock price increase in 2024 was a testament to its strong lending portfolio, particularly in commercial real estate and equipment financing. Opportunities: the bank is expanding its digital banking services to compete with larger players. Additionally, its focus on underserved regions gives it a niche advantage. Risks: a potential slowdown in Canada's housing market and higher loan defaults due to rising interest rates could weigh on earnings. Moreover, competition from fintech lenders is intensifying. Our take: while Canadian Western Bank is a solid dividend payer, investors should monitor its exposure to real estate and the impact of higher borrowing costs on its customers. Finally, let's talk about Altria Group, a dividend juggernaut with a yield of 8.2%. Known for its iconic Marlboro brand, Altria has faced declining cigarette sales but continues to thrive thanks to its diversified revenue streams. What's next for Altria? The company is aggressively expanding into alternative nicotine products, including heated tobacco and oral nicotine. It also has a stake in Juul and the cannabis company Cronos Group. Key challenges. Regulatory risks remain a significant headwind, particularly with the FDA's push to reduce nicotine levels in cigarettes. Additionally, competition in the reduced risk product (RRP) space is heating up. The silver lining. Altria's pricing power and strategic investments in alternative markets provide a buffer against declining cigarette volumes. For income investors, its dividend reliability remains unmatched. So there you have it, 5 high-performing, high-dividend stocks that are making waves in 2025. From energy infrastructure to financial services and consumer staples, these companies are navigating challenges while delivering strong returns to shareholders. Which of these stocks do you have your eye on? Let us know in the comments below. And as always, if you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Thanks for watching, and remember, this is not financial advice. Do your own research, and read the disclaimer.